In the realm of investing, a luminary rises from the shadows. Peter Lynch, a master of the craft, bestowing upon eager souls the ultimate guide to transcend from novice to pro, an extraordinary journey that will redefine their financial destiny.
Investing is a personal thing. You have to do it by yourself. You don't do it with a committee. That's the kind of money you can do well with. If you're worried about it, don't invest it.
With a voice that resonates with wisdom, Peter Lynch unveils the sacred knowledge that has propelled countless individuals from the depths of ignorance to the zenith of investment prowess, a transformative roadmap that will forever alter their relationship with wealth.
Well, I think people that are investing in individual stocks, it's sad they're careful when they buy a refrigerator or an airplane flight. They're careful with their money, and they'll hear about a stock on the bus, and they'll put $5,000 or $10,000 on it. They have no idea what they do. So you're really got to be careful. Look at the company, look at the balance sheet. What is the reason the stock should be higher? The sucker's going up is not a good reason.
Against the backdrop of uncertainty, Peter Lynch emerges as a guiding light, illuminating the path from amateur to virtuoso investor, unveiling the secrets, the strategies, the insights that will unlock the doors to untold riches and financial independence.
Well, I think people in the decade of the 80s was the best decade this century for stocks. I think people managed to lose money in the 80s doing it themselves because their methods were so flawed. So I really feel as though I wanted people to understand. I don't want anybody to buy a stock. I'm saying if you're going to buy a stock, you should do certain things.
Right.
If you're not willing to do these things, you should leave your money in the bank.
With every word, Peter Lynch weaves a narrative of empowerment and possibility, revealing the sacred knowledge that bridges the gap between inexperienced novices and seasoned professionals, the transformative guide that will forever alter their perception of investing.
You shouldn't be intimidated. Everyone can do well in the stock market. You have the skills, you have the intelligence. It doesn't require any education. All you have to have is patience, do a little research. You've got it. Don't worry about it. Don't panic.
Against a backdrop of doubt and confusion, Peter Lynch assumes the mantle of a mentor, bestowing upon eager learners the ultimate roadmap to greatness, the definitive guidebook that unravels the mysteries of the market and propels them towards unrivaled success.
You have several things that you possess that will make you a good investor. They're inherent to your life. It's the field you work in. It's the area where you live. There may be some local company that's terrific. You're a consumer. You see some products, you see some services that are terrific. We bought a Volvo. It was better than the American station wagons. It was safer. The price was right. I did a little bit of research. I found that Volvo, the stock, it's a Swedish company, was selling equal to its cash. You're paying almost nothing for the company. They had lots of other divisions that were doing terrific.
Like a sage of old, Peter Lynch imparts his hard-earned wisdom, guiding seekers on an awe-inspiring odyssey from the realms of amateurs to the realm of investment gods, where the spoils of financial prosperity await those brave enough to heed his teachings.
But another key element is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor, you're not sure this Walmart can make it. You want to check, you see them operate in small towns, you're afraid they can only make it in 7 or 8 states, you want to wait till they go to more states. You keep waiting. You could have bought Walmart 10 years after they went public and made 35 times your money. If you bought it when they went public, you would have made 500 times your money, but you could have waited 10 years after Walmart went public and made over 30 times your money. You could have waited 3 years after Microsoft went public and made 10 times your money. Now, if you knew something about software, I know nothing about software. If you knew something about software, you would have said, these guys have it. I don't care who's going to win, Compaq, IBM. I know who's going to win Japanese computers. I know Microsoft, MS-DOS is the right thing. You could have bought Microsoft. Again, I'm repeating myself, stocks are not a lottery ticket. There's a company behind every stock. And you can just watch it. You have plenty of time. People are in an amazing rush to purchase a security. They're out of breath when they call up. You don't need to do this. There's always something to worry about. And the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. You don't know to need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve? I mean, whoever cared what was under the damn curve? I mean, but you had to study this. You don't need this in the stock market. So all you have to know is you're going to see, it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well.
Well, I think looking for something different, looking for something that's a good story. I mean, who would have guessed TJX, a local company, would have gone up 50-fold, or Stop and Shop would go up 10-fold, or Analog Devices, or NVIDIA. I couldn't pronounce NVIDIA. So you have to find a company that's either a turnaround or a company that's going to grow, like Panera or, Family Dollar stores. I'm not saying that buys now, but that's what's made our, Sears is rolled over. So, so Kmart's rolled over, IBM slowed down. But we've had new companies come along. I mean, that's the nature. You have to be looking for new companies and look at the balance sheet. If you can add 5 and 5 and get reasonably close to 10, you should be able to look at a balance sheet and say, here's 2 depressed companies. They've gone from 50 to 3. One company's got $3 million in cash and no debt. One's got $3 million in debt and no cash. Which one are you going to buy? I mean, that's not too hard to do.
I'm going to try and say some words on the things I've used over the years when I was an amateur, when I ran Magellan. I still use today. I think they make sense. I think they make a lot of sense for investors. And I frankly think it's a tragedy in America that the small investor has been convinced by the media, the print media, the radio, the television media, that they don't have a chance. The big institutions with all their computers and all their degrees and all their money have all the edges, and it just isn't true at all. And when they're convinced, when this happens, when this occurs, people act accordingly. When they believe it, they buy stocks for a week, and they buy options, and they buy the Chile fund this week, and next week it's the Argentina fund, and they get results proportionate to that kind of investing. And that's very bothersome. I think the public can do extremely well in the stock market on their own. I think the fact that institutions dominate the market today is a positive for small investors. These institutions push stocks on usual lows, they push them on usual highs. For someone that can sit back and have their own opinion, know something about an industry, this is a positive. It's not a negative. First of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. I mean, if anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, it's very, I had logic, so I had a syllogism and studied these when I was at Boston College. There can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. So what I'm trying to tell you, it'd be very useful to know what the stock market is going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, or interest rates are going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that. Now, I have to be fair. I'm talking about economics in the broad scale, predicting the downturn for next year, or the upturn, or M1 and M2, 3B, and all these M's. I'm talking about economics. To me, is when you talk about scrap prices. When I own auto stocks, I want to know what's happening to used car prices. When used car prices are going up, it's a very good indicator. When I own hotel stocks, I want to know what hotel occupancy is about. When I own chemical stocks, I want to know what's happening to the price of ethylene. These are facts. If aluminum inventories go down 5 straight months, that's relevant. I can deal with that. Home affordability, I want to know about when I own Fannie Mae or I own a housing stock. These are facts. They're economic facts and there's economic predictions. And economic predictions are a total waste.
Investing is a personal thing. You have to do it by yourself. You don't do it with a committee. You have to be able to have the emotional strength to stand the volatility of the market in general and stocks in general. The key organ here is not the brain, it's the stomach. Do you have the stomach for this? Do you have the patience for it? You should be able to look in the mirror and say to myself, what am I going to do if the market goes down?
Where people buy stocks for a second and own it for a second. I mean, I think that's a waste of time. I think it's disruptive. On the positive side, information to the public is so much more available today. When a company releases their numbers and they have a call, it's open on the web to everybody.
Right.
All the information. We used to wait for the mail to come to see what Nike's inventories were like. You know, I mean, you find out we get in our library in the first class mail. So all this information. So the investing for the average person now is much clearer. They know the same thing as I do.
Yeah.
They all this. You don't want to invest in a company whose balance sheet is, they got $8 billion in debt and they have no cash and they're losing money. That's a terrible combination. You get all the information now. So information is a lot better than it was.
10 years after Walmart went public, 10 years after
Walmart.
10 years after it went public, it's a 25-year-old company now.
Right.
You could have bought the stock and made 50 times your money on it. 50 times.
So if you bought it 10 years
After it was public already.
Yeah.
It already gone up 5-fold. So you could have made 250-fold. But I'm saying, let's say you were in a town, they came into it and they said, boy, these prices are great. They're doing terrific. I like the bargains. You checked it out. You spent a little bit of work on it.
Yeah.
I mean, people are very careful. When they buy a dishwasher, they do some research. They'll put $10,000 in some stock they hear on a bus. So if you did a little bit of research, you'd say, Walmart's only 10% of the country. They're not even saturated there. Why can't they go to the rest of the country? I show examples. It's a touch more detailed. It actually shows me in action.
Right.
I picked 21 stocks early in 1992. Right. Some work, some don't. I follow those companies. Some of the companies, the fundamentals deteriorate. Some they improve. I watch those companies go through the year. I also explain the retail industry. I try and make it very simple. And I talk about a wonderful example. Is a 7th grade class.
Yeah.
The teacher of that read my book. And my first book that you were talking about, you and I did a show on that in Washington.
Right.
You remember that show? This is a long time ago. She read the book, and I said, if you made it through 5th grade math, you can do it in the stock market. She says, okay. She started teaching it in 7th grade, 7th grade class. These kids had to study companies. They had to look at their balance sheets to see if they're solvent. Yeah. And they picked stocks. These stocks were up 69% over 2 years when the market was up only 20. And they picked stocks like Limited. They picked the Gap. They picked Walt. They understood these companies. They also picked IBM. I lost money on that too. I mean, everybody makes mistakes.
Everybody did, yeah.
But I'm saying this was a school, St. Agnes' School in Arlington, Mass. Right. But in addition, in the decade of the 80s, there's 8,000 investment clubs. These are amateur, sort of average people just investing. These investment clubs, 62% of them, of these clubs, beat the market. In the decade of the 80s, only 25% of professionals beat the market. Right.
Well, we've had 13 recessions since World War II, and we've had 13 recoveries. Maybe we're going to have one. If this is a recession, it's probably the most predicted one ever. I never know when we're going to go. I'd love to know the future. I think it would help. I'd be a better investor. I'd pay $5 extra for next year's Wall Street Journal. It would really help. Right. I cannot predict the future, but this recession is so expected, so predicted. Maybe it's coming. I don't know.
And all you need to know about the stock market is it goes up and it goes down, and it goes down a lot. And that's all you need to know. Again, it'd be terrific to know what's going to happen in the economy, but I deal with facts. If inventories are going up, if copper prices are going down, if room occupancy is going the wrong way, people building too many hotels. I look at freight car loadings when I own railroad stocks. I deal with facts. I don't deal with people tell me something's going to happen in the future. You might as well call the psychic hotline for that stuff. To get a better average. You got plenty of time.
This is money you're willing to put in the market and leave it there for 5, 10, 20, 30 years. That's the kind of money you're going to do well with. If you're worried about it, don't invest it. The stock market is volatile. Individual stocks are volatile. The average range for a stock in a year is 50% between its high and its low. Stocks go up and down. The market goes up and down. If you're investing with a 1 or 2 year time horizon, you shouldn't be in individual stocks. You shouldn't be in equity mutual funds. If you've been lucky enough to save up lots of money to send your children to college and they're starting school in 2 years, what are you going to do if the market goes down?
Basically, you look now, you have 3 choices. I think if you're an investor, you can put your money in a money market fund and get 1.7, 1.5, 1.6, and it's taxed at a 40% rate. Or you can buy a 10-year treasury and get 4.7, That's taxed at a 40% rate. Or you can have some equities. And I think stocks over the next 10 years will do a lot better than 4.7 or 1.7. So I would have some of my money. Now, it's up to the person to decide how much they want to have in the stock market. For some people, 10% is aggressive. For some people, 50% is the right amount. It's a personal decision. And you can't go by these rules that if you're 25, you should be 100%. And if you're 45, you should be 50%. If you're 60, you should be 0. And I guess burping a lot. I don't know what the rules are on people at 60, but I hate those rules. I think they're pathetic.
You know, we had a terrible financial crisis in 99 to 1. I think almost every major bank in Texas went under. Bank of New England, one of the oldest banks in the country, went under. It's like, in 08, 09, the banks were doing these no-doc loans and second mortgages and home improvement loans, and people are buying boats with it. Now the bank's being much more careful. So we've gone through other crises. Some banks will go under. 400 went under after 08, 09. Now we have stress tests. I think the banking system has improved. There'll be some companies go under. That's the nature of it. It's nothing like, imagine 1980, 81, we had double-digit inflation, double-digit unemployment, and people were the Japanese were going to take over the world. I mean, we were hopeless. I mean, there's always something to worry about. I'd really, in my over 50 years of doing this, I think I'd be worried if there was, somebody didn't bring up something to worry about. That's the nature of the business.